The number came out this morning at 10 a.m. Eastern Time, and it broke something. Not in the way that market crashes break things, with sirens and circuit breakers and frantic anchors on financial television. It broke something quieter and more permanent. It broke the single assumption that the Federal Reserve, the stock market, and every Wall Street strategist who has been... And when that assumption broke, the Treasury market, which is the foundation that every other financial market is built on, began to do something it has only done a handful of times in the last 50 years. It started pricing in stagflation, not as a tail risk, not as an academic scenario in a research note, as the base case. By the end of this video, you are going to understand exactly what the University of Michigan's final April consumer sentiment reading, released this morning on April 24th, 2026, actually says, and why the specific number inside it, not the headline number, but the inflation expectations figure, is the data point that the Federal Reserve watches more carefully than any other single monthly statistic. You are going to understand why that number, combined with the Q4 2025 GDP revision that came out at the start of this week, and the February jobs report that showed the American economy actually lost 92,000 jobs against expectations of a 55,000 gain. When the Treasury yield that has been moving in the wrong direction at the worst possible moment constitutes the precise combination of conditions that defines stagflation in technical economic terms. You are going to understand why the Federal Reserve meets on April 29th, 5 days from now, with a set of options that ranges from bad to catastrophic. You are going to understand what the Iran war's mines in the Strait of Hormuz, which were confirmed to be newly laid this week, mean for every one of these numbers over the next 60 to 90 days. And you are going to understand why the Treasury market's specific behavior in the last 72 hours is not an overreaction to bad data, but an accurate pricing of a scenario that changes everything about the investment environment for the rest of 2026. Let us start with the number that triggered this script, because most people read the headline and missed the data point that actually matters. This morning, the University of Michigan released its final April consumer sentiment reading. The preliminary reading, released on April 10th, was 47.6. The lowest reading in the 74-year history of the survey, lower than the Great Recession, lower than COVID lockdowns, lower than the worst months of the 1982 recession when unemployment was above 10%. 47.6, a number that the survey's director, Joanne Hsu, described by saying consumer sentiment sank about 11% this month, extending a decline that began with the start of the Iran conflict and is currently about 9% below a year ago. The final reading this morning came in at 49.8, which slightly beat expectations that had been set at the preliminary level of 47.6. The market breathed a small sigh of relief at 49.8 versus 47.6. What the market did not adequately process is what 49.8 actually means in historical context. The index has only been at this level, or lower, during the most severe economic crises in modern American history. Every single recession since the survey began has been preceded by readings above where we are right now. The current level of 49.8 is below the index's value at the start of all 6 recessions, recorded since the survey's inception. But here is the specific number inside the Michigan report that broke the assumption. It is not the 49.8 headline, it is the year-ahead inflation expectation reading. The final April reading for one-year inflation expectations came in at 4.7%. The March reading was 3.8%. That is a 0.9 percentage point jump in a single month. The largest one-month increase in this specific metric since April 2025. And the long-run inflation expectations, meaning where ordinary Americans think prices will be 5 to 10 years from now, rose to 3.5%. The highest reading since October 2025. 4 months ago, long-run expectations were between 3.2 and 3.3% for multiple consecutive months. 3.5 is a meaningful move away from that range in a single month. Here is why these two numbers matter so much more than the headline sentiment figure. The Federal Reserve does not primarily set policy based on where inflation actually is. It sets policy based on where inflation expectations are going. The reason for this is one of the most well-established relationships in all of monetary economics. Expected inflation becomes actual inflation. When businesses expect prices to rise 4.7% next year, they set their prices today based on that expectation. When workers expect prices to rise 4.7%, they negotiate wages based on that expectation. When landlords expect 4.7% inflation, they set rent increases accordingly. The expectation itself is inflationary, independent of whatever the actual underlying data would otherwise produce. This is what economists call the wage price spiral, and what Federal Reserve Chair Jerome Powell has described repeatedly as the risk of inflation expectations becoming unanchored. The Fed declared victory over unanchored inflation expectations in late 2024 and through most of 2025. It cut rates 3 times in that period. It signaled more cuts were coming. The bond market priced in further easing. And then February 28th, 2026 arrived. The Iran war began. The Strait of Hormuz closed. Oil went from approximately $80 per barrel to a peak of $166 per barrel on March 19th in Dubai. Gasoline prices at American pumps went from $2.98 before the war to above $4 this week, where AAA data as of Sunday, April 20th, showed the national average at $4.05 per gallon. And the Michigan Survey's one-year inflation expectation went from 3.2% in January to 3.8% in March to 4.7%. In this morning's final April reading, the expectation is accelerating. It is not stabilizing. And the most important word in that sentence is accelerating, because an inflation expectation that is moving upward at this pace does not respond to patience and watching. It responds to action. And the specific action that would normally arrest a rapidly rising inflation expectation is raising interest rates, which brings us directly to the most important meeting on the American economic calendar in the next 90 days, which is the Federal Open Market Committee meeting on April 29th, 5 days from now, where the Federal Reserve will sit with this data in front of them and make a decision that has no good options. Before we get to the Fed's impossible position, let us add the rest of this week's data to the picture, because the Michigan sentiment number did not arrive in isolation. It arrived on top of a stack of data that has been building a specific and alarming case all week: the Q4 2025 GDP revision. The advance estimate for fourth quarter 2025 gross domestic product was released at the start of this week, and it came in at 0.7% annualized growth. The initial estimate had been 1.7%, a revision of 1 full percentage point lower, from 1.7 to 0.7, is not a data revision in the normal sense. It is a significant restatement of the economic reality of the final quarter of last year. The American economy was growing at less than 1% annualized in the quarter immediately before the Iran war began. Less than 1% is not a comfortable runway for an economy about to absorb an energy shock of the scale that the Strait of Hormuz closure has produced. The February jobs report. The United States economy lost 92,000 jobs in February 2026. Not gained, lost. Against a consensus expectation of a 55,000 job gain, the economy reported negative 92,000. A swing of 147,000 jobs from expectation to reality. The February report captured the initial economic impact of the war's start on February 28th, combined with a continuation of the hiring slowdown that had been developing since the second half of 2025. The hiring rate at 3.1% was the lowest since April 2020. Companies that were already cautious about adding headcount before the war began moved to outright hiring freezes in February as the geopolitical uncertainty arrived. The New York Fed's Empire State Manufacturing Survey for April, released this week, showed conditions deteriorating sharply, with the General Business Conditions Index falling to negative 14.5, the lowest reading since October 2025. New orders fell, shipments fell, prices paid jumped. That specific combination inside a manufacturing survey, orders and shipments falling while prices paid rises, is the textbook signature of stagflationary conditions at the sector level. The manufacturing sector is not leading indicators are not pointing to recovery. They are pointing to contraction with simultaneous cost pressure. Earnings season this week added specific corporate-level confirmation of what the macro data is already showing. ServiceNow plunged 18% on Thursday after its quarterly guidance disappointed expectations. IBM fell 9% after its first quarter results, showed software growth decelerating from 7.5% in the fourth quarter of 2025 to approximately 5% in the first quarter of 2026. Lockheed Martin, which should be a beneficiary of elevated defense spending, fell 5% as its first quarter earnings missed estimates by 26 cents per share, and its revenue came in below consensus at $18.02 billion against expectations of $18.24 billion. Even Thermo Fisher Scientific, which reported a first quarter revenue beat of $11.01 billion against expectations of $10.85 billion, explicitly noted on its earnings call that it expects the Middle East conflict to create some modest level of inflationary pressure. The technology sector, which has been carrying the S&P 500's record highs on its back throughout 2026, is now showing precisely the deceleration that the macro environment predicts. When the companies that are supposed to grow through anything cannot grow through a persistent energy shock and the resulting consumer confidence collapse. The valuation premium those companies carry needs to be reassessed. The S&P 500 fell 0.42% on Thursday to 7,108. The Nasdaq fell 0.89%, and the Dow Jones Industrial Average fell 0.36%, as the specific combination of new Hormuz mines and software earnings disappointments collided on the same trading day. Now let us connect all of these data points to the Treasury market, because this is where the script's title lives, and the connection is specific and mechanical rather than atmospheric. The 10-year Treasury yield has been the most sensitive real-time barometer of the stagflation risk throughout this conflict. At the start of the war, the 10-year was below 4%. As oil prices spiked and inflation fears mounted, it climbed to 4.34% on April 7th when Trump issued his first midnight ultimatum. It spiked to 4.46% on April 16th, when the latest ceasefire announcement came with conditions that the market immediately understood were fragile. It has been range-bound between 4.2 and 4.5% since then, with Schwab's market update this morning noting that the 10-year yield touched an 11-day high earlier in the week, and that both the yield and the dollar index remain sensitive to war news and could rise if tensions flare. That sensitivity to war news is the specific mechanism that makes the current moment more dangerous than a normal stagflation scare. In a normal stagflation episode, you have rising prices and slowing growth driven by domestic factors, whether supply shocks or excessive monetary stimulus or structural labor market problems. The Fed can assess those factors, model their duration, and make a judgment about whether to tighten to fight inflation at the cost of further slowing growth or to hold and hope the supply shock resolves on its own timeline. In the current episode, the primary driver of the inflationary pressure is a military conflict in the most important oil transit choke point on Earth. And that conflict has an element of duration uncertainty that no economic model can capture. The Strait of Hormuz has opened and closed 3 times in 50 days of war. The ceasefire that was supposed to open the strait was extended on April 22nd, when Trump said the ceasefire would be extended until an Iranian proposal is submitted. Iran responded by laying new mines in the strait this week, which Axios confirmed through a United States official and a source with knowledge of the situation. Trump on Thursday ordered the Navy on Truth Social to shoot and kill any Iranian boats laying mines with no hesitation. The UK Maritime Trade Operations Centre issued a warning that activity in the strait is high. Iran seized 2 cargo ships this week, claiming they attempted to transit without authorization. An Iranian gunboat fired on a container ship this week, causing heavy damage to the bridge. The Strait of Hormuz has not reopened to normal commercial traffic. Brent crude is back above $100 per barrel after briefly falling on the initial ceasefire relief. 2 cargo vessels, but no tankers, had crossed the strait on Thursday, according to ship tracking data from LSEG. At least 9 tankers in total have transited the sea lane since the ceasefire was extended Monday. Before the war, approximately 20 million barrels per day transited. 9 tankers in a week is not 20 million barrels per day. The physical energy market is nowhere near normal. And as long as the physical energy market is not normal, the inflation impulse that drives one-year expectations from 3.8 to 4.7 in a single month does not stop. It compounds. Here is the specific mechanism by which this week's data broke the Treasury market's assumptions, and it requires understanding the specific constraint that makes this stagflation trigger different from every other inflation scare the Federal Reserve has navigated in the last decade. The Federal Reserve's credibility as an inflation fighter rests on 2 foundations. The first is its willingness to raise rates when inflation is rising, even at the cost of economic pain. The second is the stability of long-run inflation expectations, which provides evidence that the public believes the Fed will maintain its commitment to the 2% target even when short-run prices are elevated. When Paul Volcker raised rates to 20% in the early 1980s to break the stagflation of the 1970s, the mechanism that eventually worked was not the rate itself, but the credible commitment it demonstrated. Once the public believed the Fed would accept any level of economic pain to restore price stability, expectations adjusted downward, and the inflation became self-correcting. The current Federal Reserve has been managing a different kind of constraint since the Iran war began. It held rates steady at its March 18th meeting, at the target range of 3.5 to 3.75%, citing the need for clarity about the geopolitical outlook before adjusting policy. This was the right decision given the genuine uncertainty about whether the war would last days, weeks, or months. The problem is that the Michigan Survey's long-run inflation expectations have now risen to 3.5%, which is significantly above the 2% target, and which tells the Fed that the public's trust in its ability to keep long-run inflation anchored is beginning to show wear. 3.5% long-run inflation expectation is not a crisis number. It is not the 8 or 9% long-run expectations that characterized the 1970s stagflation at its worst, but the direction is the specific danger. In January, long-run expectations were 3.2%. In February, 3.3%. In March, 3.2% again. In the preliminary April reading, 3.4%. In today's final April reading, 3.5%. The trend is clear, and it is moving in the wrong direction at the exact moment when the Federal Reserve has the least room to respond. Why does the Fed have the least room to respond? Because the American government is running a deficit of 6.4% of GDP, has $39 trillion in outstanding debt, and is paying over $1 trillion per year in interest on that debt. The interest bill already exceeds the defense budget in the first 3 months of this fiscal year. When Yellen said in January that the preconditions for fiscal dominance are clearly strengthening, she was describing precisely the constraint that the Federal Reserve now faces in April. If the Fed raises rates to fight the rising inflation expectations that the Michigan survey is showing, it increases the cost of every Treasury bill and bond the government needs to roll over. It increases the government's interest burden, it increases the deficit, it requires more Treasury issuance, and it pushes yields higher in a feedback loop that makes the fiscal problem worse, not better. If the Fed cuts rates to support an economy that lost 92,000 jobs in February, grew at 0.7% in Q4, and has consumer confidence at the lowest level in 74 years of survey history, it adds monetary accommodation to an economy already experiencing 4.7% one-year inflation expectations, which tells every business, landlord, and wage negotiator in America that prices are going to be higher next year than the Fed is pretending. The accommodation becomes inflationary, the inflation becomes a self-fulfilling expectation, and the long-run 3.5% expectation, that is the current warning sign, becomes 3.8%, then 4.1%, then the spiral that Diamond called the skunk at the party. If the Fed holds, as it did in March, it buys time at the cost of letting the situation develop further in whichever direction it develops. If the situation develops toward a deal and an oil price decline, holding looks like patience rewarded. If the situation develops toward continued Hormuz disruption, new mines, gunboat attacks on tankers, and oil above $100 for another 60 days, holding looks like the Fed watching stagflation entrench itself while pretending it's waiting as a policy choice. The FOMC meets on April 29th, 5 days from today, 5 days after the data that broke the assumption. The unanimous consensus among every economist and every rate futures market is that the Fed will hold rates unchanged at 3.5 to 3.75%. The Fed funds futures market is currently pricing the first possible cut as no earlier than the third quarter of 2026, with the most likely scenario being no cuts at all until there is genuine evidence that energy prices and inflation expectations are declining. That consensus is probably correct. The Fed will almost certainly hold. But the specific statement that Chair Powell delivers after the April 29th decision, and more importantly, the specific press conference where he'll be asked directly about the Michigan 4.7% one-year inflation expectation and the 3.5% long-run expectation, and the Q4 0.7% GDP revision and the February 92,000 job losses, and the new mines in the Strait of Hormuz, will be the most scrutinized Federal Reserve communication since the post-pandemic rate hiking cycle began in March 2022. Because the question that every reporter, every analyst, and every investor needs Powell to answer honestly is not what the Fed will do on April 29th. It is what the Fed will do if this persists for another 60 days. What does the Treasury market do with that uncertainty? It prices the uncertainty into yields, and yields are already at levels that the Schwab market team this morning called sensitive to war news and capable of rising further if tensions flare. The 10-year yield at current levels is already the highest sustained level since mid-2025. If Powell's April 29th press conference is interpreted as a Fed that is genuinely concerned about inflation expectations, but unable to act because of fiscal constraints and slowing growth, the bond market will do what bond markets do when they believe a central bank is behind the curve. They sell, yields rise, and the Treasury market's reaction to the April 29th press conference will be the first clear signal about whether the fiscal dominance dynamic that Yellen described in January has arrived as an active market force, or whether it remains a structural concern without immediate market expression. Here is the specific thing about the current market environment that makes the Treasury market's reaction to this week's data so consequential beyond the immediate trading week. The S&P 500 is at 7,108 as of Thursday's close. The Buffett indicator, which measures total stock market capitalization relative to GDP, was at 232% at its last reading in March. At current equity levels, with Q4 GDP revised down to 0.7% annualized, that ratio may be even more extended than it was in March. The valuation premium of the stock market relative to the economy is sitting at its highest ever recorded level, while the economic data this week has confirmed that the economy grew at near zero in Q4, lost jobs in February, and is sending consumer confidence to the lowest level in 74 years. The gravitational force of interest rates on asset prices that Diamond described in his annual letter is being felt in real time this week. The technology sector's earnings disappointments, software names that missed guidance, the IBM deceleration, the Lockheed margin pressure are not company-specific stories. They are the first clear corporate-level expression of what a persistent energy shock, elevated interest rates and collapsing consumer confidence does to the earnings trajectory of companies that were priced for a world of 2% inflation and steady 3 to 4% growth. That world, if it ever fully existed in 2026, is not the world that this week's data describes. The specific convergence of this week's data points creates what economist and financial analyst Luke Groman has described in the context of the current war as the most dangerous economic environment since the 1970s, because it has the same fundamental characteristic as the 1970s. The shock is to supply, not demand. The Federal Reserve's tools work on demand. They cannot build refineries. They cannot clear sea mines. They cannot reopen the Strait of Hormuz. They can only make borrowing more expensive, which slows demand, which eventually slows price increases in demand-driven inflation. But when the price increase is coming from an 18% reduction in global oil supply because the most important energy transit choke point in the world has been mined, blockaded, and contested by gunboat attacks, making borrowing more expensive does not solve the problem. It adds a demand shock on top of a supply shock. And the combination of a supply shock and a demand shock is the textbook definition of stagflation. Q4 to 2025 GDP at 0.7% is the demand shock arriving. The Michigan 4.7% one-year inflation expectation is the supply shock's price expression arriving. The February 92,000 job losses is the labor market beginning to reflect both simultaneously. And the Treasury market, which is the most sophisticated aggregator of forward-looking economic expectations available to human observers, is sitting with its 10-year yield range-bound between 4.2 and 4.5% in a posture that says the stagflation scenario Diamond called the skunk at the party is no longer a tail risk. It is a central scenario being priced alongside, but not yet in replacement of the base case scenario of a ceasefire and recovery. The most important line from Charles Schwab's market commentary this morning, published at 9:14 a.m. Eastern on April 24th, 2026, is not about the stock market or about earnings. It is this: long-run inflation expectations, which rose to 3.4% in the preliminary report from 3.2% in March, are worth a close look. Any uptick might attract the Fed's attention as policymakers remain concerned about keeping long-term inflation expectations anchored. The final reading that came in at 3.5% this morning is the uptick that Schwab was warning about before it happened. 3.5% is the highest long-run inflation expectation reading since October 2025, and it arrives at the precise moment when the Federal Reserve is 5 days away from a policy meeting with no good options. Now let us talk about what happens over the next 30 to 60 days, because the data from this week does not live in isolation. It is the beginning of the first quarter 2026 earnings reporting period and the first read on second quarter economic conditions, and both of those sequences will provide either confirmation or contradiction of the stagflation scenario that this week's data is building. The FOMC meets April 29th. The advance estimate for first quarter 2026 GDP arrives the same day. The first quarter growth number is being watched with specific anxiety because the war began on February 28th and the Hormuz closure began the same day, meaning the entire first quarter GDP estimate will incorporate 3 full months of an economy operating under an energy shock of historic proportions. The IEA has described the current situation as the greatest global energy security challenge in history. The first quarter GDP estimate that arrives on April 29th will tell the market whether the energy shock has already pushed the United States economy into negative growth territory, or whether the pre-war momentum from the strong Q3 and Q4 2025 numbers was enough to keep the headline positive. If the first quarter GDP comes in below 1% or negative on the same day, the Fed holds rates steady and Powell tries to explain why holding rates in the face of 4.7% one-year inflation expectations is the correct policy. The Treasury market will be forced to process simultaneously the confirmation of both halves of the stagflation definition in a single afternoon. Negative or near zero growth, confirmed. Above target inflation expectations, confirmed. Fed unable to address either one without worsening the other, confirmed. In that scenario, the 10-year yield does not fall on the growth concern. It does not rally on ceasefire hope. It stays elevated on the structural concern that the Fed is caught between its two mandates in a way it was not caught at any point during the post-pandemic recovery. On April 29th, earnings from Microsoft, Amazon, Alphabet, Meta, and Qualcomm are all scheduled to report after the market close. These 5 companies collectively represent approximately 25% of the S&P 500's total market capitalization. Their first quarter results will cover January through March 2026, meaning they will include the first 4 weeks of the Iran war's economic impact. The specific items to watch in those reports are cloud computing revenue trajectories, which are sensitive to enterprise cost-cutting when energy costs are rising and consumer confidence is falling. advertising revenue, which is the most real-time indicator of corporate marketing budgets, and is historically the first line item cut when companies see sales slowing, and guidance for Q2 2026, which will be the first forward-looking statement from America's largest companies about what they expect in the quarter that fully incorporates the war and its aftermath. If the guidance from even one or two of these 5 companies is below current consensus expectations, the market will face the same question that the Michigan sentiment number posed this morning. Is this a temporary disruption that resolves when the ceasefire becomes a deal? Or is this the beginning of the earnings deceleration that the valuation of 232% of GDP has been assuming would never arrive? Goldman Sachs Asset Management's Alexandra Wilson Elizondo provided the specific phrase that best captures the current moment when commenting on last week's core inflation data. She said, "The market was braced for a hot print, so today's inline number is a slight relief. However, it may be the best headline inflation number we see for a while, as it may only partially capture the full force of the Iran conflict. The next several months of CPI and PCE data will capture the full force. The Michigan survey's 4.7% one-year expectation is telling you in advance what those data prints are likely to show. When consumers who are buying gasoline at $4.05 per gallon, buying groceries at prices that reflect higher transportation costs, paying rent in a market where rising interest rates have frozen supply, tell a survey researcher that they expect prices to be 4.7% higher. Next year, the data that follows is very likely to show that expectation was not unreasonable. The Federal Reserve has one tool that does not require it to choose between fighting inflation and supporting growth. It is transparency. The April 29th press conference is the opportunity for Powell to tell the American public and the global financial system exactly what the Fed sees, what it is concerned about, and what conditions would cause it to change course in either direction. If he uses that opportunity honestly, the market will at least know what the Fed is watching and what the thresholds are. If he uses it to reassure without specifics, the market will interpret the vagueness as uncertainty. And uncertainty in a Treasury market that is already pricing a novel and unresolved risk environment is a recipe for the yield volatility that amplifies every other problem in the financial system. The University of Michigan Survey's director Joanne Hsu ended her April commentary with a sentence that deserves more attention than it is receiving. She said economic expectations will likely improve after consumers gain confidence that the supply disruptions stemming from the Iran conflict have ended and gas prices have moderated. 2 conditions. Supply disruptions have ended. Gas prices have moderated. As of this morning, April 24th, 2026, neither condition has been met. New mines were laid in the Strait of Hormuz this week. Trump ordered Navy boats to shoot and kill mine-laying vessels. Iranian gunboats fired on tankers. The ceasefire has been extended, but the naval standoff that prevents commercial oil tankers from transiting continues. Brent crude is above $100 per barrel. The national gasoline average is $4.05, up from $2.98 before the war. Neither of Hsu's conditions for improving expectations has been achieved. The conditions that produced 49.8 sentiment, 4.7% one-year inflation expectations, and 3.5% long-run expectations are still fully present this morning when the final April data was released. The preliminary reading of 47.6 was taken 98% before the ceasefire was announced. The final reading of 49.8 incorporates the ceasefire, the extension, the subsequent mine laying, the gunboat attacks, and the ongoing blockade. The final reading is only 2.2 index points better than the preliminary record low. The ceasefire bought 2.2 index points of confidence improvement. The mines bought them back. What this tells you about the next 30 days is specific and sobering. If the ceasefire continues to hold in its current form, meaning guns quiet but naval standoff active, Hormuz commercially closed, blockade maintained, new mine-laying accusations and gunboat incidents continuing, the May Michigan preliminary reading will not show a significant rebound. The conditions for the rebound, actual supply restoration, and actual gas price moderation are not present. The May CPI print will show the full force of April's energy prices. The second quarter GDP, which will be reported in late July, will reflect the entire second quarter under war conditions, including whatever oil prices and supply chain disruptions that quarter produces. The trajectory, absent a genuine resolution, is the trajectory that the data from this week is already showing. Slower growth, higher prices, a Fed that cannot meaningfully address either without worsening the other, a Treasury market that has lost its normal role as a safe haven because rising inflation concerns push yields up at the same time that rising recession concerns would normally push them down, and a stock market sitting at 7,000 on the S&P 500, at a Buffett indicator of over 230% of GDP in an economy that grew at 0.7% in Q4, lost jobs in February, and has consumer confidence at the lowest level in the survey's 74-year history. The specific question for every person watching their portfolio, their retirement account, their mortgage rate, their credit card interest rate, their grocery bill, is whether this week's data represents the moment where the benign ceasefire optimism that produced the record equity highs of the last 2 weeks begins to give way to a more honest accounting of what the economic data is actually showing. 4.7% one-year inflation expectations, 3.5% long-run expectations, 0.7% Q4 GDP, negative 92,000 February jobs, new mines in the Strait, oil above 100, gas at $4.05, consumer sentiment at 49.8. These numbers do not describe an economy on the verge of a strong recovery once the ceasefire holds. They describe an economy that was already slowing before the war began, and that is now absorbing a supply shock of historic proportions that is simultaneously pushing prices up and pushing confidence down. The Federal Reserve meets in 5 days with no good options. The first quarter GDP arrives the same day as that meeting. The biggest technology earnings in the world report that evening. And the Strait of Hormuz remains contested by naval forces on both sides, with new mines confirmed this week. Jamie Dimon called it the skunk at the party. Janet Yellen said the preconditions are clearly strengthening. Jerome Powell said it will not end well if we do not do something fairly soon. This morning's University of Michigan final April reading said it in the language that ordinary Americans speak, rather than the language of economists and central bankers. It said 4.7%. That is what they expect. That is what they will demand in wages, in rent negotiations, in price-setting decisions across every sector of the American economy. And that expectation, confirmed and rising in the final data released this morning on April 24th, 2026, is the stagflation trigger that broke the Treasury market's assumption, and that the Federal Reserve will be sitting with in 5 days when it has to tell the world what it plans to do about a problem that none of its tools can directly solve. The data is in. The assumption is broken. The Fed meets in 5 days, and the Strait of Hormuz still has new mines in it as of this morning. That is where we are on April 24th, 2026. The question of what it means for the rest of your financial year is the question that the next 90 days of data will begin to answer in a way that nobody, not the market optimists, not the ceasefire traders, not the taco trade believers, and not the Federal Reserve itself, can postpone any further.